Welcome aboard to Aussie Financial Chronicles. Today, we're diving into a topic of immense importance. The $37 trillion US dollar currency reset has begun, and we're discussing its devastating ripple effects right here in Australia. Let's jump in. I'm Dr. Vulcan Temis. I create crucial finance videos specifically for Australians. Before we start, please don't forget to subscribe to my channel and make sure you watch this video right through to the end. Headline: Billion-dollar danger. The $37 trillion currency reset has begun. The Australian Agenda Introduction. The erosion of the US dollar's privilege. America is desperately trying to change the rules in the gold and cryptocurrency markets. Their government is sitting on a colossal debt of $35 trillion. They aim to essentially start from scratch by moving this debt onto crypto and the cloud, effectively devaluing it. The US government has a massive problem, and that problem is about to jump across the Pacific and hit your wallet and your home right here. For decades, the US dollar status as the global reserve currency has granted the United States an enormous privilege, but that privilege is now showing signs of vanishing. The US dollar's share of global foreign reserves has fallen to its lowest level in 30 years. Meanwhile, US government interest rates are sitting at their highest levels in 20 years. As a result, the government's interest payments have skyrocketed from $500 million to $1.2 billion in just 5 years. Interest payments alone now account for more than a fifth of the government's total revenue. This is what the European Central Bank calls the debt doom loop, a vicious cycle where a loss of confidence leads to higher interest rates, which then triggers budget problems. The US solution, a crypto reset and the risk premium. The US government, however, believes it has found a solution to this problem: a massive cryptocurrency reset. They believe this could halt the doom loop and allow the government to continue spending recklessly. To fully grasp what this major crypto reset entails, we must look closer at interest rates. The 10-year government bond interest rate is driven by three fundamental forces: inflation, the discount rate, and the term premium or risk premium. The risk premium reflects investor confidence in US debt. Today, the risk premium on the 10-year US Treasury bond is at 0%. This is a massive potential risk that could cause interest rates to skyrocket further if investors suddenly decide that US debt has become truly risky. If the risk premium simply reverts to its historical average of 2%, today's 4% interest rate instantly jumps to 6%. This would not only have catastrophic consequences for the government's budget but would be the final nail that drives the US economy into a deep recession. Critical facts Australians aren't being told. New section 1. The mortgage cliff. Interest rate rises hit you directly. Attention, this isn't just America's problem. American interest rate hikes are a hurricane that directly hits Australian homeowners. Australia has one of the world's highest household debt to GDP ratios. Millions of Aussies are facing the mortgage cliff as their short-term fixed rates rapidly reset to variable rates. A nightmare 6% interest rate in the US ties the hands of the RBA Reserve Bank of Australia. As rates continue to climb, our rental markets are collapsing, rents are soaring, and homeowners are facing bankruptcy. This is the clearest evidence that the Australian dream is rapidly turning into a nightmare. The role of the crypto market, stablecoins, and the China threat. Between 2000 and 2024, the US dollar represented at least 60% of global reserves. However, in the last year, that reserve share has fallen below 60% and is declining fast. The biggest driver behind this is the selling off of US debt by major foreign holders like China and Japan. The US government is trying to counterbalance this phenomenon, which it cannot control, through crypto. Point 2. China's collapse. Australia's economic security is at risk. So, what does China selling off US treasuries mean for Australia? This is the second huge danger Australians are not aware of. China isn't just selling us debt, it is battling its own massive internal debt crisis. As we watch the collapse of Chinese construction giant Evergrande, demand for the backbone of the Australian economy, and natural gas is eroding. China's slowdown means the closure of Australia's largest revenue stream. Billions of dollars in export revenue will vanish, and job losses will begin everywhere from the mining sector to the services sector. This is not just a trade skirmish. It is a direct threat to Australia's economic security. This is where stablecoins, digital dollars, come into play. The market cap of stablecoins has doubled in just 2 years and is now hovering around $200 billion. For stablecoins to be in circulation, they need to be backed by a real US dollar. This means stablecoin companies must purchase US Treasury bonds to issue stable. This implies that high demand for stablecoins equals high demand for dollars. US Treasury Secretary Scott Bessent believes a $2 trillion market cap for stablecoins is a reasonable estimate. If this happens, stablecoin companies would become the world's largest holders of US Treasury bonds, with bigger holdings than the combined governments of both Japan and China. This would completely offset any reduction in US Treasury holdings these governments might make. The plan's limits and risk warning. However, this plan has major limitations. Foreign investors only account for about 24% of US debt holders, which totals over $35 trillion. Even if stablecoins reach a $2 trillion market, this represents only a small fraction of the total debt pile. Yes, the government's crypto plan is a decent one, but it will only have a positive impact on interest rates if it is accompanied by a sound government budget. If the government continues to spend recklessly, you will see more capital move away from US treasuries and into assets like gold and Bitcoin, which benefit from the loss of confidence. 3. Retirement nightmare. Your superannuation savings are at risk. The seemingly untouchable fortress of the financial markets is also under threat. Australia's compulsory retirement system, superannuation. This should be your third and most personal concern. Superannuation is the biggest safety net Australians have for the future. But as global balances are overturned, these massive funds are also losing value. Governments may set their sights on these super funds to cover budget deficits or finance major projects. Remember, global uncertainty and high inflation are quietly destroying the purchasing power of your retirement savings. It is only a matter of time before your savings are worth nothing more than a handful of dust when you retire in 30 years. Gold is experiencing one of its strongest rallies in history. This is a clear sign that investors no longer believe the dollar and dollar-linked debt are attractive investments. Conclusion: where is your security? In summary, the US government hopes to overcome its debt problem and the declining global trust in the dollar through stable. However, the danger is at Australia's doorstep, the mortgage cliff. Homeowners and renters are under massive pressure due to interest rates and local debt burden. The China crisis, Australia's main revenue stream, exports, faces the danger of collapse with China's economic slowdown. The superannuation threat. Global instability is quietly destroying the purchasing power of your retirement savings for a lasting positive effect. Reckless spending must stop, and a sound budget must be implemented. Otherwise, capital will continue to flow into safe havens like gold and Bitcoin. Isn't it time you stopped entrusting your savings solely to the system and started shifting them into genuine value protectors like gold and Bitcoin? Final call to action, CTA. Thank you for watching my video right to the end. If you like our video and subscribe to the channel, we can have the chance to meet you again here with new, extremely valuable finance videos. Come on, fingers to the subscribe button. See you in the next video. Goodbye. Oh, and don't forget, we are giving away our PDF digital library of 2,000 books for free to valuable viewers who comment in the description section below. Endless thanks for supporting us by subscribing, sharing, and commenting. I love you all very much. Goodbye.
Did you know that right now, 1 in 5 Australian mortgage holders is officially struggling to make their repayments? The average Aussie family is forking out hundreds, sometimes thousands, of extra dollars on their home loan every single month compared to just a year and a half ago. This has everyone asking the big question: is the Reserve Bank about to burn the whole house down just to put out the inflation fire? Welcome to the Aussie Finance Chronicles. Today, we're diving deep into the ticking time bomb that the RBA's aggressive rate hikes have planted right in the middle of Australia. As property market. Whether you're a homeowner, a renter, or just trying to save, this video is essential for understanding how this crisis is hitting your wallet. Let's get into it. So, where did this all start? The core of the problem is inflation. After the pandemic, a perfect storm of supply chain issues and huge consumer spending sent prices soaring. The RBA's main job is to keep prices stable, and their number one tool for that is hiking the official cash rate. Think of it as the economy's brake pedal. When they push it, borrowing money becomes more expensive, which is supposed to cool down spending and, in turn, inflation. But these hikes have sent a massive shockwave through the entire economy. Mortgage repayments have skyrocketed for anyone on a variable rate. But the real danger, the one that keeps economists up at night, is what we call the mortgage cliff. Hundreds of thousands of homeowners who locked in super low fixed rates of around 2% during the pandemic are now rolling off those deals. They're facing a brutal reality check with new rates of 6 or even 7%. For many households, this isn't just a budget adjustment. It's a full-blown lifestyle crisis that's forcing impossible decisions. This rate shock is creating a massive squeeze on everyday Australians. It's a painful double whammy. At the exact same time your mortgage or rent is going up, so is everything else. Your grocery bill, your car insurance, your electricity bill, it all costs more. This is wreaking havoc on family budgets. People are draining their hard-earned savings, canceling holidays, and even taking on second jobs just to stay afloat. And if you think this is just a homeowner's problem, think again. Where do you think landlords pass on their soaring mortgage costs? You got it, straight to their tenants. Rents in our major cities have exploded to record highs, pushing more and more people into rental stress. The RBAS rate hikes aren't just hurting property owners. They're pushing thousands of Aussie renters closer to the poverty line. It's a vicious cycle, and it's dragging everyone down with it. So, where do we go from here? Honestly, the experts are split. The optimists believe the RBA has done its job. Inflation is coming under control. And we might even see rate cuts towards the end of 2020 for Titanque, heading for a soft landing. The pessimists, however, are painting a much darker picture. They warn that the full impact of these rate hikes hasn't hit yet and could trigger a serious downturn in house prices. This would put pressure on the banks as they face a rise in bad debts from people who can no longer afford their loans. The market's biggest fear is that the RBA has slammed the brakes too hard, steering us straight into a recession. For investors, this chaos creates both risk and opportunity. Traditionally defensive sectors like essential services, energy, and supermarkets tend to hold up better. But consumer-facing industries like retail and residential construction are feeling the pain. The next few months will be critical in showing which side of the forecast was right. So, what can you actually do to protect yourself in this financial storm? First, get forensic with your budget. It's time to ruthlessly track every dollar and cut back on non-essential spending. Every little bit counts. Second, if you have a mortgage, don't just sit there and accept your rate. Call your bank and negotiate. See if you can refinance to a better deal. Loyalty rarely pays in banking. And third, and this is the most important one, build your emergency fund. Aim for at least 3 to 6 months worth of essential living expenses. This buffer is your financial lifeline. This is arguably the most challenging economic period Australia has faced in a generation. Being informed is your best defense. What do you think? Is the RBA getting it right, or are they making a huge mistake? Let me know your thoughts in the comments below. If you want to stay ahead of the curve on the Aussie finance market, mortgage trends, and personal finance tips, make sure you hit that subscribe button and turn on notifications. You don't want to miss what's coming next. Thanks for watching, and I'll see you in the next video.